Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Matt Barry, Vice President of Product Management and Head of Capital Markets at Touchstone Investments, Arne Noack, Head of Xtrackers Americas at DWS, Ben Slavin, Global Head of ETFs at BNY. We're here to discuss why ETFs continue to be the vehicle of choice for many investors and what factors are driving the trend. It is great to have all of you with us. Welcome to Trade Talks. Matt, let's kick it off with you. The ETF evolution over the past few years has been nothing short of remarkable when you think about it in terms of growth.
Yeah, absolutely. So we continue to see the biggest trend being just ETFs continue to surge in their growth. They had $1.2 trillion of net inflows over the past 12 months. And within that, active ETFs are becoming a very prominent part of the market. If you go back 5 to 7 years ago, active ETFs were a smaller part of the ETF market. Most investors associated passive investing and ETFs together. We've seen that change pretty rapidly, where the last 8 quarters, quarter over quarter, we've seen active ETFs grow more than the previous quarter, over $100 billion the first quarter this year, and over a third of ETF inflows. So it's becoming a very meaningful part of the market.
Yeah. And Arne, what are the most meaningful trends that you've been able to discern prior to Liberation Day and then following it?
Yeah, that's actually an interesting question, Jill. As a sort of a follow-on to Matt's point, active ETFs is certainly something that we observe as a structural trend in the ETF market, and one that I would say has very much survived the sort of the friction point around the Liberation Day deadline, but something that sort of when you look deeper into the asset flows in ETFs, something that hasn't quite survived, for example, is significant interest that was live for Chinese exposures, Chinese A shares as well as H shares. We saw significant client flows into that. We saw the market recover locally quite meaningfully. And of course, unsurprisingly, with the US administration's focus now on China as the, let's call it, principal focal point of the tariffs, that interest has largely waned in the US. Generally speaking, something that we weren't so sure what we would continue to see is sort of overall interest for international equity exposure. We saw significant inflows on our range into our currency hedged international exposures, for example, EFA or Europe, but on a currency hedged basis prior to Liberation Day. I would say the international developed focus has shifted a little bit since Liberation Day to the unhedged type of exposure, because of course the dollar continues to show some weakness in light of the ongoing development. So there's some nuanced points around that, but by and large, international remains relatively strong.
Yeah, and Ben, let's talk about some trading volumes here. I believe April 7th was a record in terms of ETF trading volume.
Without a doubt. I mean, for the ETF industry and also at BNY, we saw multiple records fall in terms of volume coming through our platform on successive days. And really, it's a testament to the resiliency of the ETF structure. And, but I would say on top of all of these trends, certainly active, Arne just mentioned a few of the main categories where we see flow going. There's also been this continued trend out of mutual funds. And what's interesting is we saw that the last couple years, and that trend's accelerating, money going into ETFs, out of mutual funds. But if you look at that period in early April, just earlier, a few weeks ago, that first 2 weeks in April, we saw that spread blow out. And if you look at the data, the real-time data that we're able to look at through our own distribution platform at Pershing, which is part of BNY, that delta between outflows to mutual funds and inflows to ETFs was about 3x the normal rate. And it's very interesting to see. And part of it is that trend towards actively managed ETFs, but also just investors using ETFs to do tactical positioning in these times of market volatility. And it's a go-to wrapper for exactly that purpose.
Yeah. And Matt, let's talk about strategy here for a moment in terms of outlook, and where do you see the opportunities lie within the ETF space? What's gaining traction?
Yeah, so where we're having a lot of conversations is on the fixed income side, first and foremost, where there's still pretty competitive, compelling interest rates out there, where investors are looking to potentially not dip their toes in too far into the risk assets. We've seen the flow support that with a lot of inflows into fixed income actively managed ETFs, and drilling down ultra short income in particular. keeping the short interest rate duration, not taking too much risk there, high quality strategies. That's been a place for investors to look without, in the current volatility environment, without taking on too much risk there.
Yeah. And Arne, let's talk about Xtrackers ETFs in the US in particular. I know you'd mentioned the European trade, which in fairness was outperforming the US trade prior to Liberation Day, to your point earlier. What are some of the strategic priorities that you're seeing within Xtrackers?
Yeah, both sort of, I would say, interesting points on both the strategic and potentially more tactical side, and sort of following on to something that Matt said in relation to fixed income. Part of our footprint here in the US is actually a meaningful presence with regards to US high yield bonds, both on sort of the higher quality high yield bonds as well as general market high yield bond exposure. And high yield bonds is interesting because over the last year, that's a category that has seen meaningful inflows of almost $17 billion. And even year to date, that category still is very much in the plus. However, over the last month, so essentially the month of April, has seen $4 billion worth of outflows. Over the last week, a lot of spread compression has meant those clients who still sort of believe that recession fears might be a little bit overblown are starting to come back. So over the last week, we're seeing about $2.8 billion flow back, but the month of April has still been severely negative from that perspective. Something that for us sort of on a more strategic basis is interesting is some of our sort of equity strategies that are, I would say, more thematically oriented. And in particular, one strategy that we have that incorporates a filter around geostrategic risk ratings is starting to be of interest. Essentially, about a year and a half, almost 2 years ago, we launched that fund, and essentially it has a look to say, hey, the big technology companies in the US, they're involved in what the Department of Defense label as critical technologies. This could be cybersecurity, could be biotech, but a lot of them have exposure to potential adversaries like China or Russia in terms of their supply chain, their governance structure. And essentially we developed a strategy that passes out and only invests in companies that mitigate those potential geostrategic risks. And that's obviously now in light of sort of the ongoing tariff war, something that we see of strategic importance.
Yeah, that is an interesting strategy. But I want to ask you about alternatives and ETFs. We're hearing more advisor demand as it relates to alternatives as we're looking to differentiate their offerings. Tell us about some of the trends that you're seeing, and then are all alternative strategies appropriate for the ETF wrapper?
It's a great question that is coming up more frequently. Certainly, at this point in the market cycle, alternatives are more attractive from an investor standpoint, looking for those type of uncorrelated returns. And that could be because of the market volatility. Certainly, there's been a lot talked about regarding the concentration of the Mag 7 and the S&P 500, just investors looking for a different return profile. But certainly, there is a lot of push to try to get these types of strategies into the ETF wrapper, which is certainly attractive. And, that presents an opportunity really for the industry to try to get these products to market. But as you, I think, alluded to, it's not necessarily suitable for all investors. And second, the ETF wrapper, albeit very flexible, has its own limitations, and certainly things like liquidity and the need to daily, value the portfolio are some complications that make it very challenging to get some of those strategies into that ETF wrapper.
Yeah. Ben, let's talk about outlook for a moment here as well when we think about innovation and what's next for the ETF space. That also includes share classes. Give us some background on that and what the impact could be to innovation and new product as it relates to share classes.
It's a game changer, Jill. I think certainly we've seen record product development the last couple of years. And basically this year it hasn't slowed down, and it's coming from all sides, new issuers, existing issuers, and different product types. The ability to launch a share class could really see, again, more records fall in terms of new product development. It provides a tool for asset managers to get products to market, but do so in a way that they haven't been able to do before, which is to launch it as a share class from an existing mutual fund pool. And ultimately, when the SEC acts on this, and again, it is still pending, but there is a consensus forming that this is coming sooner rather than later. The possibility to have an ETF share class, and it's particularly relevant off an actively managed strategy as well, and allow those products to come to market with assets, a track record, and a structure that is already in the market that makes it, frankly, just easier and more cost effective for asset managers to launch.
Yeah. And Matt, you had made the point before how this volatile environment supports the case for active management. When you think about your outlook in the ETF space, how do the broader capital markets or the macro environment we're in, does that impact the pace of innovation at all for ETFs?
Yeah, it does. I mean, the more volatile, the more opportunity there is to launch new innovative products. And just to piggyback off what Ben was saying a moment ago, I completely agree that ETF as share class is probably the next game changer in the space. We filed last year. We were about the 10th or 12th filer. We actually just this morning submitted our revised filing. And the trend towards a consensus, towards optimism that's going to get approved has been really remarkable how fast it's changed. So I think that's coming soon. And another key benefit is investors could, trillions of dollars of mutual funds assets, especially in active products, they can move over without realizing a taxable impact at ETF to share class. So that's a key benefit that can really help scale that. And that's probably the next key innovation we see in the industry.
Yep.
All right.
And Matt, I would say, no, I was also just going to add, you made another good point, but it also allows not only those investors to switch without a taxable event, but it also allows ETF shareholders to coexist with those who are in retirement plans, which has always been a challenge for many plans to actually hold ETFs. And so that's another wrinkle here that could be very important for the industry and investors as a whole.
We're actually seeing ETFs could potentially launch mutual fund share classes to open up retirement plans to existing ETFs that haven't been able to do that before, which is an interesting wrinkle.
I did not realize that you could not, that there was a challenge there as it relates to retirement plans and ETFs. I thought both could be held. So I learned something new, because that was my question to you, Ben, was going to be what's the impact on the investor, but you read my mind. So thank you for addressing that. I want to wrap this up, go back to the international conversation for a moment here. As DWS thinks about its overall strategy, we know it's worked for 2025. Do you see that continuing to be a strategy longer term? And then what's your thoughts overall as it relates to innovation within, whether it's Xtrackers or the broader ETF space?
Yeah, absolutely. So DWS, for those who don't know, we're a €1 trillion asset manager headquartered in Frankfurt, and as such, we present ourselves and are often seen by our clients as, if you will, a gateway to Europe in particular, given our core competency and home over there. But ultimately, let's say, have significant expertise with regards to, anyway, international investing from a US-centric point of view. So that obviously, let's say, over the last 10 years or so, wasn't exactly en vogue. The topic of US exceptionalism was plain and simple to see for everyone. Home bias is significant. However, 2025 so far has been doing its best to bring back the topic of diversification back to people's minds. And we don't see that abating anytime soon. Of course, US stock market isn't losing in relevance. Personally, I find the whole talk around potentially the US dollar being in danger of losing sort of its supremacy or place as the global reserve currency somewhat overblown. However, all of those things at the margin don't mean that international investing should not have a more prominent role in people's portfolios compared to what it's been playing over the last, let's say, 10 or potentially even 15 years since the end of the global financial crisis. So essentially, long story short, the answer to your question, Jill, is yes, we very much see that the topic of international diversification being super relevant for us, because US investors, by and large, and obviously generalizing here, but they come from such a low base and see their portfolios have such a significant home bias that loosening up that home bias, we see a tremendous opportunity, and we want to be here for advisors to help with education. Remind people that when you're a US-based investor, all of your liabilities, your mortgage payments, your school payments, your life happens in US dollar. And when you invest abroad, not only do you need to take a view on which are the good companies potentially to hold, but hey, what does it mean if I hold that company in a currency different to the US dollar, and what are the implications from a risk, from a return profile, and from, let's say a liability-oriented type of investing. So these are all topics that we love to engage in, that sort of we live and breathe on a daily basis, and we very much see ourselves in the driving seat and the forefront of investor education here.
We're seeing those same trends on the international side, where the two most recently launched ETFs from us, one was international developed, and then the other emerging markets ex-China. We're having a lot of interesting conversations around that, as Arne talked about earlier in the conversation, flows going into China, flows going out of China. What we see from a large segment of investors is either concern and wanting to avoid Chinese investment exposure, either from an investment concern or political concern, or being able to more target, dial that exposure up or down with a China ETF to complement an ex-China strategy. So that kind of pairs well with what he was saying.
Yeah.
And it's a very good point, Matt, because what investors might not realize, China has become such a significant component of essentially the ACWI ex-US index, the emerging market index. So treating China, which is sort of the second largest economy in the world, or purchasing power parity adjusted, even the largest economy in the world, treating that as a block in its own right is very important from an overall international asset allocation perspective.
Yeah. And I think it goes back to what's reflective of what RIAs are looking for to differentiate their practices when it comes to, okay, what other areas can we look at ex-US? And of course, incorporating alternatives into the portfolio. So it really does support the case for more innovation within the ETF space. Appreciate all of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.